think we are extremely, extremely fortunate to be living in India in this 30, 40 year period where the country is getting integrated. The next decade, there'll be enormous wealth creation for people who are mentally prepared to grab those opportunities. Just make sure you're one of those who's mentally prepared to grab the opportunities that the Indian economy presents as it consolidates into the hands of well-run businesses.
Hello and welcome everyone. I am Vishal Khandelwal and this is the 1% Show. This show is an open ended exploration into the minds of the wisest people around to help us learn to think, invest, and live each day a little, even as little as 1% better. You can learn more at vishalkhandelwal.com. My guest today is Saurabh Mukherjea, founder and CIO of Marcellus Investment Managers. Saurabh was educated at the London School of Economics, where he earned a BSc in economics with first class honors and an MSc in economics with distinction in macro and microeconomics. In London, Saurabh was the co founder of Clear Capital, and in 2007, he was rated by the Excel survey as one of the top small cap analysts in the UK. In India, Saurabh was rated as the leading equity strategist in 2015, 16, and 17 by the Asia Money polls. Prior to setting up Marcellus, Saurabh was the CEO of Ambit Capital. He has written multiple best selling books that include Coffee Can Investing, The Unusual Billionaires, Gurus of Chaos, The Victory Project, and his little one, which is The Diamonds in the Dust, which I'm really loving as I'm reading it. It's about the process he and his team follow at Marcellus to identify businesses that can compound shareholders' wealth over time and thus lead to extraordinary wealth creation. With this and no further delay, Saurabh, welcome to the 1% Show and thank you so much for agreeing to do this and for the wonderful lessons that you have shared all these years through your books and other writings.
Thanks, Vishal. Thank you for inviting me, and I've learned a lot from you and from your shows. So thank you very much for inviting me on the 1% Show.
My pleasure, Saurabh. Thank you. So, my first question is about your growing up years, your family background, student life, and lessons that played a role in what you became as an adult. I got to know by reading an interview that you did somewhere else that in your early days in England in the 1990s, before you were even 18, you delivered newspapers and bathroom fittings, you cleaned stores and worked in a betting shop. So, what were those days like, and what were the most important lessons that you learned?
So look, I mean, at one level, they were normal teenage years. I went to school and went to college in London and so on. I suppose where life was a little unusual for us is my parents migrated to the UK when I was 15. So as is usually the case with migrant families, the initial years are tough emotionally and financially tough. So to help out the family, I took up a newspaper round where I used to deliver the evening newspaper. I chose the evening newspaper because it was a little less cold in the evening than it was in the morning. And then when I became a little older, I started working in a first local bathroom fitting store on Saturdays, and then I started working there Monday to Saturday, cleaning the store, delivering various things. And then once I learned how to manage myself at work, I got myself a pay hike by leaving the bathroom fittings job and getting a job at the local betting shop, because in betting shop you have to do a little bit of maths in your head, and that meant I got a pay hike. But very fulfilling years. I would argue I learned more from those jobs, both in terms of people skills, how businesses work, how risk and reward works in the workplace. I probably learned more from those jobs, Vishal, than I did from my education through my teenage years.
Yeah, and what were the most critical lessons that if you were to enumerate a few lessons that you learned during those
I think
days?
the first thing is I learn is there's only you're not going to get very far in life by just getting marks in exams. You have to learn how to build relationships with people. It might be a colleague 20 years older than you who's working with you. It might be a customer that you see every day for 2 minutes. But unless you build relationships, whether it's with customers, with colleagues, with friends, you're not gonna really achieve much in life. I think that's a for especially for people like us from middle class Indian backgrounds, where you're taught that exams karo and exam mein number lao. It was a very big learning for me, and I'm so glad I got that early in life. That exam mein number paake beyond the point, it's not going to help you very much in life. I think the second thing which I learned at the betting shop, and which has sort of helped me throughout my professional career, is you learn that if you trade less, you might actually make more money. So at the betting shop, there used to be some customers. They used to come and sit there all day, bet every hour, but the poor fellows never seemed to make much money. And there were other customers who used to come once a day, typically early in the morning, place the bet, and then go to their office and spend the whole day in the office. And I used to see that some of those guys had a very good winning track record. So I then and that was the first time in my life I learned to understand trading behavior. I had no idea about the stock market when I was 17, 18, 19, but I started talking to these people. How do you do it? How do you figure out which horse will win or which cricketer will score runs? And they told me that, look, we wake up in the morning at 5:30, we read three newspapers with a cup of coffee. We've been doing this for 10, 20 years. And effectively, in your and my parlance, they were analyzing fundamentals scientifically by reading newspapers. And these turned out to be the best betters or the best investors. They would place one bet thoughtfully after 2, 3 hours of deliberation. They would take emotion out of the equation because they were not in the betting shop when the actual match was being played. And I realized they make way more money than those poor fellows who sit and bet all day long. So the difference between a day trader and a fundamental investor, I learned that not through, say, lovely books like Poor Charlie's Almanac, which I can see behind you, but through more straightforward things like watching people in the betting shop. So that practicality of reading the world, reading people, building relationships, a lot of that turned out to be very valuable for someone like me who comes from a middle class and academic Indian family. The knowledge that padhai likhai beyond the point is not going to take you very far. That got hammered into my head in those teenage years of working.
Uh, let's talk about Clear Capital, which you co-founded, right, around 2004, and you were doing really well with the firm, right, an equity research firm. What made you give up on that and the Western life and shift back to India? That too in 2008, when the financial system globally, including India's, was struck by a deep crisis. And also, in your experience of investing in the Western markets and then in India, what are the similarities and differences you have found?
So let me try to wrap both of those questions into one. So Sir John Kay had a big influence on my thinking, especially in the first 10 years of my career. So after I graduated from the LSE, I joined John's firm, John's economics consultancy called London Economics, and that's when I first learned what John calls sustainable comparative advantage, concepts which we have elaborated upon in my previous books, but we will have elaborated upon with lots of case studies in the new book Diamonds in the Dust, right? So around the age of 21, 22, 23, I started learning about what is comparative advantage, hota kya hai, why are some companies able to build sustainable comparative advantage and others aren't. And that learning that John gave me when I was working in this economics consultancy basically got translated into stock market research when I co-founded Clear Capital in 2003, and we did extremely well. We basically applied John's construct of sustainable comparative advantage, identified high quality British small caps, recommended them to family offices and institutional investors, and made a lot of money for them and thus for ourselves. But what happened in January 2007 was, uh, we sat down and did some maths, and John was critical in driving our thinking. And we realized in Jan 2007 that the British financial system is going to blow up, right? And in fact, we were able to identify by February 2007 which banks in the UK, which NBFCs in the UK are going to blow up. So, basis that thinking, we started getting our clients to sell their holdings in the British stock market. By the end of '07, Vishal, by and large, we've got our clients out. And that's when it struck us that not just the UK, but even the United States is going to blow up. So we sat down with our colleagues, with the venture capitalists who backed us. John K was also a shareholder, and the decision that was taken was that there is a financial crisis coming. Whilst we are doing really well at the moment, we might not be able to survive the crisis, and the decision was taken in January 2008 to sell Clear Capital. Right, and just to be clear, we were selling Clear Capital because we saw with great clarity the blow up that was coming. Right, and I, I still just I was in 2007. I was 31 years old, and with John's help, with my colleagues' help, we just saw with incredible preciseness क्या फटेगा, कैसे फटेगा, कब फटेगा. So we put the firm up for sale, and with the grace of God, in March 2008, we found the buyer. 10th May 2008, the company, we got paid for selling the company. And by then, the concept of comparative advantage had been deeply sort of embedded in my head. And I told myself that, look, if I can identify companies with sustainable comparative advantages in the British context, in a more virgin economy, in a younger economy, in a more nascent economy like India, this must be even more doable, right? If in a developed world context you can identify companies with competitive advantage and make money out of it, then surely in a underdeveloped setting with less liquidity in the market, this should be more viable. And largely based on that premise, Vishal, we migrated to India. In May 2008, just as the first IPL was underway. Basically saying that if we could apply academic constructs like comparative advantage and make money in the UK, it'll be that much more feasible, possible to generate good returns in the Indian context. So that's what brought us back to India 13 years ago. Yeah, 13 years ago.
Sure. And the second question, right, in terms of your experience of investing in the Western market in India, right? So, what are the similarities and differences you found, like in terms of while you're analyzing companies, businesses in India over the last 13 years, right, or probably more than that, versus analyzing businesses in the Western market? So, what are differences and similarities
Yeah.
that you can talk
So,
about?
so the best way I can give you an example how to think about that is, say I live in a suburb of Bombay. Okay, I live in a suburb of Bombay. There are lots of restaurants in the suburb of Bombay I live in. Lots of restaurants. At least must be just within a half a kilometer radius of where I live. There must be at least 25 decent restaurants. Okay, and figuring out which is the best restaurant, best value for money, highest quality cuisine, it'll take a fair bit of work because they're all at a decent standard. It's a competitive market for restaurants in the suburb of Bombay I live in. It's a place called Hiranandani Powai. It's an affluent area and competitive market. Therefore, for restaurant food, you and I would we will be able to figure it out, but mehnat karna padega. We'll have to eat 25 dishes, you know, create a spreadsheet, create some ratios, and figure out which is the best restaurant in Powai, Hiranandani. But if you and I were to go to say to Dhanbad, if you were to go to Dhanbad tomorrow, my reckoning is, if people from Dhanbad are watching this, you can correct me, but my reckoning is there'll probably be half a dozen good places to eat in Dhanbad. And my reckoning is probably no more than 2 to 3 hours of eating. You and I will be able to say this restaurant is clearly the best restaurant in Dhanbad across these metrics, right? And what we will see is the return on capital for the best restaurant in Dhanbad, the return on capital for the best restaurant in Dhanbad or in Kanpur will be significantly better than the return on capital on the best restaurant in Hiranandani Powai. Right? This is a larger market, बहुत कुछ हो रहा है, but competition is greater, right? Because there are so many people trying to sell restaurant food to Saurabh in Hiranandani Powai. The return on capital is lower. Dhanbad mein, the competitive intensity is lower, the return on capital is much higher, right? But you do have to make the effort. You and I have to make the effort to go to first. I think we'll have to go to Kolkata and then drive for I think 3 or 4 hours to reach Dhanbad. But if you do the mehnat, we will unearth the Dhanbad restaurant, and unfortunately it's not listed. But if you were willing to resettle in Dhanbad, you could earn high ROC in the Dhanbad restaurant market, right? And I think that example I'm trying to give is exactly how India versus a Western market operates. So as I speak to you, I'm wearing a Relaxo ka chappal, right? This is my Relaxo ka chappal, right? The return on capital on Relaxo, you can go and check, is 30-35%. Every alternate year they do capex. So जिस साल capex करते हैं थोड़ा return on capital नीचे चला जाता है, but across a 5, 6, 7 year cycle, return on capital on Relaxo is around 30%. Right? You cannot sell a chappal in the United States or UK or France for even 15% return on capital. And the reason is exactly the Dhanbad versus Powai restaurant example I gave you, right? So this is why when we go to Indore or Kanpur, we hear about superb local fare, dominant local franchises, wealthy owners of these restaurants. But you won't see too many such people in Bombay or Delhi because here the restaurant market is far more competitive, and that's one of the paradoxes of life. Market is bigger in Bombay or Delhi for restaurant, but competitive intensity is higher. Return on capital therefore is lower. Ulta reverse applies in Indore or Dhanbad or Kanpur, and that's how you can compare India versus the Western world. The return on capital is greater here. Competitive intensity unquestionably is lighter here, right? Unquestionably competitive intensity is lower here, right? If I look at my own company, if I look at Marcellus, in with I would love to believe my colleagues and I have done a good job in 3 years. You still have to be realistic about it. Uh, 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 in 3 years, we've been able to build a company which, say, in the PMS industry, has only five other relevant competitors. Uh, if I had tried building this in London or New York, there'd be at least 100 competitors, right? So the opportunity set is greater in London and New York. Market is bigger, but the competitive intensity is much higher, and that's how you have to attune your skill set. In India, therefore, if you're able to find promoters who are relatively honest, clean people, they are rational, दिमाग है, right? Rationally business चलाते हैं, and they have a good barrier to entry. They have a good moat in their market. You will make a lot of money. But in the West, that sort of business will be much harder to find, right? You cannot turn up in London or New York and find a apparel manufacturer which has, forget jockey or page industries, is 60% ROC. आपको 20% ROC का apparel manufacturer भी नहीं मिलेगा because competitive intensity is insanely high in the Western apparel market.
It's interesting you mentioned or you gave an example of Dhanbad versus say, Mumbai. So, Dhanbad is a land of mines, as I understand, right? And if I were to equate Dhanbad with India, India would be a land of landmines as far as investing is concerned, right?
Right,
In terms
right.
of corporate governance and everything compared to the Western world. I'm sure there are issues there as well. But in terms of, I remember talking to you a few years back, right? And you mentioned that in India, when you talk to an Indian, generally, when they say no, you are not sure whether they really mean no or it's an yes, right? So, dealing with investors, dealing with companies, right? Even when you find a high quality business with moat and everything, and you believe that the managers are running it well in terms of corporate governance, right? I'm sure it must not have been an easy task for you to really separate what is really true versus what seems to be true in India compared to maybe a Western world. So, how has been your experience on that front?
So I think first thing we realized is, um, there's no it's not as if people are fundamentally more dishonest in India. A lot of people think like that, but it's not true. It's not as if the Indian promoter is fundamentally more dishonest than the Western promoter. If you are cynical, you should believe that nobody is दूध का धुला हुआ anywhere in the world, right? Everybody in a way is opportunistic at some level. But what does happen is, and I'll continue with the Dhanbad example because it brings it out beautifully. I hope everybody who's watching this has watched Gangs of Wasipur. If you haven't watched Gangs of Wasipur, you should. I think it's essential education for an Indian investor to watch Gangs of Wasipur, especially those who buy metals and mining stocks. You should watch Gangs of Wasipur so that थोड़ी अकल ठिकाने आ जाए आपकी, right? But coming using that example, right? So look at Tata Steel, right? Uh, from the Tata Group, so governance is relatively solid, right? As you and I know, Tata Steel, they get their ore. The ore is basically free for them because they have had the ore deposits for, I think, 100 odd years. Not the Odisha wala, but in the Jamshedpur. In Jamshedpur, their ore, they're basically getting it for free. And the coal is also free because they have got captive collieries, right? So if I told you that if one of the largest steel companies in the world with over a century of experience gets the ore free and the coal free, you'd presume they'd make lots of money, no? Common sense would say they have to make money, because how can you not make money? आपको ore और coal अगर free में दिया जा रहा है, you've been doing this for a century, you will be making bucket money hand over fist. But if you look at Tata Steel's accounts, you will see TCS makes more free cash flow in, say, 1 year than Tata Steel makes in 10 years. Another way of saying the same thing is Tata Steel's return on capital seldom exceeds its cost of capital. Right? Tata Steel's return on capital seldom exceeds the cost of capital, which is the same thing as saying free cash flow बहुत कमजोर है. So what exactly is going on here, right? They are not the Tata Group is a high quality, well run group. How can they not be making money in steel, right? A product which they're synonymous with. So basically, there are three things happening in the background, and this is why I'm using the Tatas as an example because they're a high quality group. If they find it tough, imagine how other Indian families who are not as established as the Tatas find it. पहला तो है that the system is messed up. So, Gangs of Wasipur will hopefully anybody who hasn't watched it should watch it because it'll give you a sense how messed up the system is, right? District magistrate ho, local politician ho, state level politician ho, national level politician ho. Whether you're running a hotel, you're running a real estate business, you're running a mining business, you're running a telecom business, you're running an airline business. In India, you have to deal with a whole ecosystem of people who are after your happiness, right? So that's the first level of challenge that an Indian promoter faces that the Western promoter doesn't face to this extent. The second is let's assume we've been able to deal with the ecosystem, the environment, with the politicians and the civil servants. Even then, you have to figure out how to get your stuff to market in a country where transport systems are still not the greatest, where road networks, even though NHI has doubled the road network in the last 10 years, it's not the greatest. The freight corridors are still not the greatest, right? So anything which is bulky, heavy, the working capital cycle, the transport cost of the working capital cycle ends up being the next big drain. If you notice Western economies, say let's take the UK for example, from any point in the UK, even the center of UK to the ports is barely a 2 hour drive, and even for a heavy truck. The highway networks are good, and it's a coastal country. Even in the US context, they take Pittsburgh, where the steel industry is centered. From Pittsburgh to reach the ports on the US East Coast is a 3-4 hour drive. In contrast, to go from Dhanbad to a port in Kolkata, get your stuff on a ship is tough, right? And hence, the second area where the Indian promoter gets killed is working capital. माल को move करने में ही time लगता है. On your inputs, you end up incurring cost. On your output, you end up incurring cost. So the second system level drag, which kills the Indian promoter, is working capital cycle. And the third layer, and this bit is in a way the big change in the country that I've seen. The third layer is until recently, the Indian economy was fragmented. Each state was a little market by itself. So I remember very vividly, Vishal, when I came to India, we did a little trip to Lucknow. I remember just to understand the lie of the land. This is more than a decade back, and I was astonished. Within 50 kilometers out of Lucknow, on the backs of buses and auto rickshaws, I saw cooking oil brands I'd never heard of, sabun brands I'd never heard of, and I realized that within 50 kilometers out of Lucknow, the FMCG market was like a cottage industry. वो अपना ही कुछ अपना माइक्रो इकोसिस्टम चल रहा था. It was that fragmented an economy. Forget the country. Even UP was fragmented into chota chota local economies, right? Because there was that fragmented. Now, if you have a fragmented country, fragmented economy, your scale of ambit, your scale of operation gets restricted. This piece finally has been rectified through highway networks, broadband, GST. So the economy is gradually getting integrated. But the first two things, which is where the governance issues kick in, the promoter is pushed into a corner by the system in terms of how he has to lubricate the system. And the job of operating a business becomes very difficult because of how hard it is to deal with the working capital cycle. These are the two drivers, and what you and I have to do is just use our common sense on this. So if you meet a construction company, say road construction company, और वो आपको दिखाता है 20% ROE, unless you are mad, you're going to start asking yourself, हो क्या रहा है यहाँ पे, right? If you meet a road construction company and they claim that they are clean, and they just give flowers and chocolates to everybody और कुछ नहीं देते, again you have to ask yourself, can this be real? So as long as you keep your wits about yourself, थोड़ा कॉमन सेंस का इस्तेमाल, थोड़ा प्रैक्टिकलिटी का इस्तेमाल, you watch movies like Gangs of Wasipur, you spend good time, quality time in places like Dhanbad, Kanpur, Ranchi, Patna. अकल ठिकाने आ जाते हैं लोगों के, and you start understanding how to talk to promoters and figure out which yes is a yes and which yes is actually a no.
Great point. Talking about your book, Diamonds in the Dust, right? You have equated investing with Test cricket and have specifically mentioned about Rahul Dravid, who is supposedly one of the best batsmen India has ever produced, right? So, tell us more about this biggest lesson that investors can draw from this analogy of Test cricket, and especially from Dravid in your own language.
I think there's three layers you can think about this, right? The first and obvious layer is high quality investing, really lucrative investing is actually very boring, right? I mean, with all due respect to my book and to your show, we are trying to we're trying to make it more interesting, you and I, in a collective endeavor. But honestly, high quality investing, like great batsmen, like a Sunil Gavaskar, like a Dravid, is actually very boring, right? So it's a relevant and important analogy, right? Because what works in life, what makes you rich, what makes you money, what makes you successful, often is actually very unexciting, right? And the best way I can exemplify that is Dravid's career, which is why we use Dravid as an analogy in the book, right? That here is a man whose batting was boring, right? He was the wall, but the statistics bear out that he was spectacularly successful. He's the best number three. The statistics bear out he's the best number three batsman in the history of the game. The statistics show that he's won India more test matches than any batsman abroad, right? He's won India more test matches and series abroad than any other Indian batsman. The statistics bear out that he did so by playing more balls than any other batsman in the history of Test cricket, right? So what's boring often is what's very successful, and I think investing and Test cricket batting are identical in that regard, right? The second is the importance of mental training in both regards. So in Dravid's case, right, when we think of cricketers and we think of उसका cover drive कैसा है या उसका square cut कैसा है या hook कैसा है, right? When we watch cricket, especially because you and I are non-cricketers, when we watch cricket on TV or in a stadium, we can only appreciate the physical aspect of it. But what made really Dravid stand out was his mental training that he put himself through from the age of 10. From mental visualization exercises to meditation to basically yoga to psychologically preparing himself for opponents to going through a whole ritual before every innings to calm himself down and prepare himself. And I think that's where this has a massive analogy with investing. A big part of successful investing is being in the right frame of mind, right? So I think in that context, I can't praise you enough for having the Buddha in the background, because a big part of investing is having that equanimity, that stable mindset, saying I'm in no rush, I'm not feeling greed, I'm not feeling fear. I really couldn't care about this at many levels. I see this extremely rationally, right? And that's the second analogy also, the boring aspect, the psychological strength aspect, and the final aspect, which is the technical prowess, the technical ability to spot your mistakes, understand your mistakes, step one, and then rectify them, step two. Rectification goes back to mental strength, right? So the third aspect, right, and we have given examples in Diamonds in the Dust of Dravid's spectacular ability to figure out where he was going wrong. Other cricketers endure spells of bad form, and soon you find that they're dropped from the Indian cricket team, never to return again. This man, whenever he got dropped, he never got dropped from the Test team for obvious reasons, but he did get dropped from the one day team in the late 90s. He watched his own video analysis, figured out his weakness, and then created a plan to cultivate, to act, to adjust, to address his weakness, and came back to the Indian team in '01 and in 2002, that World Cup final, the World Cup final, which we lost to Australia. In that World Cup, Dravid was very successful as a keeper, and he really never looked back after that, right? So that has great parallels with investing, right? Investing में आप गलतियां करोगे, right? And sometimes the galti might be bad luck, but sometimes the galti might be your mistakes could well be a deficiency in your thinking and your research, and you have to introspect more than anybody else. You have to introspect and figure out what is the mistake, where is the deficiency, where is the technical shortcoming, and address that and move forward. But I don't think there's any other sport which can give us as rich a analogy, because no other sport is played over 5 days, right? No other sport, and unless you play the sport over 5 days, you're not able to see the impact time has, and mental strength has, and patience has on outcomes. Which is why I find Test cricket so interesting and such a relevant analogy to investing.
I'm sure. I think that Test cricket also gives us that playground in the sense to apply the rules. The I think playing by the book, as they say, right? Keeping things simple, right, rather than overshooting yourself, which is required in T20, right, and not in Test cricket. So the simplicity part, right, basically, and which is also a hallmark of Rahul Dravid's career. If he were to see, most of the time he was playing by the book, right. Playing those orthodox shots and still ending up as being one of the greatest of all time in the cricket history. Continuing with simplicity, right? I would like to talk about I think one of the most talked about approach, which is the coffee can investing approach, right? I've heard you talk about the importance of simplicity in investing, and I could relate it to the same concept that you have written in the Coffee Can Investing book. Now, when I go back and read Ben Graham, right, he talked about defensive investors and aggressive investors. And when he talked about defensive investors, it was more of a coffee can approach, which is to buy good established companies which have done really well. So the coffee can approach, as I understand, is buying those kinds of businesses where you think the fabric has not changed and you think this is not going to change meaningfully in the future, and then acting not a lot in the stock market. You're actually not acting a lot, right? Is that the framework that coffee can is all about? So in terms of how do you simplify that concept for people, and over the years of practicing this approach to investing, what are the drawbacks that you've experienced?
So if we start with Rob Kirby, right, and how Rob Kirby framed it in his 1984 paper, which anybody can download and read. It's a lovely PDF. Just do Rob Kirby coffee can, आपको PDF download मिल जाएगा. Rob Kirby's main insight was that, and he was a fund manager in Capital in Los Angeles, and his main insight, based on his own investments, were that whenever he had bought, say, a dozen and a half high quality stocks, and let the stocks be for a decade, he found he would do much better than when he was trading in and out of stocks, right? So his main insight was buy dozen and a half stocks, and put them in a coffee can, a coffee jar, right? And lock the coffee jar and put it away for 10 years, and you will make a lot of money, right? That insight is mind blowingly simple, and it's mind blowingly powerful, right? Which is why, as soon as I read it, and my friend and guru Sanjay Bhattacharya asked me to read this paper, I think 6 or 7 years ago. As soon as I read it, I thought, oh my God, what a powerful concept, right? Now the question then arises, ठीक है, रॉब कर्बी साहब बोल रहे हैं buy a dozen and a half high quality stocks and put them in a coffee can and put it away, but ये high quality stocks होता क्या है? What's the definition of high quality stocks? And for a couple of years, I have to confess, Vishal, thoda sa, I tried around various things as to what exactly means what is a high quality stock. And then I realized that if I'm going to test this idea empirically, अगर rigorous, robustly test करना है, then I have to use a common definition of what is high quality over long periods of time. If I just subjectively say कि 2000 में ये stocks मेरे को पसंद आए और 2007 में कुछ और पसंद आया, then that's a very subjective, and because I'm doing it with hindsight, I'll have hindsight bias in my selection, which is a useless process, right? So I said we have to settle upon two common metrics, two, three metrics which define high quality, right? And I was we were trying various things, and they were working, some were not working. Which is when I remember 6 or 7 years ago, this Forbes magazine, they hosted a round table of a few fund managers in the Taj Hotel. I attended with a few other fund managers. So Bharat Shahji was also amongst the attendees. There were, I think, 7 or 8 of us. And Bharat Shah ji said that the simplest way to understand a good business is look at the return on capital and look at the revenue growth. And that's when I said, let me now try to use these two metrics to define quality, and let me set a threshold that return on capital above 15% every year for a decade is one definition of quality. And the other definition of quality is साथ ही साथ I need to see double digit revenue growth every year for a decade. So I said, let's stick to this common definition and go back as far back as India में data available है, which unfortunately is 1991. And now let's do 10-year slices, rolling basis pay, applying this common tests, right? And the results were first published in the Unusual Billionaires, and then as we understood the results better, we published Coffee Can Investing. Um, I'll give you guys one little secret. There's a variety of other variants we have tried, right? We're still working on something, but it'll be very, 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 very difficult for someone else to come up with a simple method like that, which outperforms the coffee can. It's ridiculously simple. It's ridiculously effective. And if you're an amateur investor, i.e., you've got a day job and you only do investing part time, it'll give you a straightforward way via which you can consider investing your hard-earned monies. Right now, what is the drawback with this? The drawback, I'll go again back to the Western world versus India comparison, or the restaurant market in Hirandani Pawai and the restaurant market in Dhanbad comparison. Restaurant market in Bombay, Delhi, big city, and the restaurant market in Dhanbad. If you and I go to Dhanbad, identifying the best restaurant in Dhanbad will be relatively easy, and we could have a discussion कि वो steak बेचेगा या नहीं. I don't think he will sell, but if he did sell, I think there's a really good possibility we can make good money in Dhanbad or Sholapur or Kanpur, small cities. May buying the top restaurant franchise in that city, I think next 4, 5, 6 years we'll make good money. But as Dhanbad or Sholapur, Kanpur, as these cities grow, there'll be more competition that will come in. And where will the competition come from? It will come from national chains, right? So a Pizza Hut or a Domino's or a Subway, etc. They will invade the smaller towns as well, right? So आज की डेट में सतारा में शायद सबवे नहीं है, but I guarantee you 3 साल में सतारा में सबवे होगा, and McDonald's होगा and Burger King होगा. So if you and I bought that steak in that restaurant in Dhanbad and said हम life के लिए set है boss, right? It's not going to work, because as the economy in Dhanbad grows, there will be competitive intensity increase. Same thing will happen to India, right? Gradually, as our economy grows, there will be competitive intensity increase. But just to contextualize it, we are a super poor country today. Our per capita income is $2,000. In 10 years' time, we'll roughly be where Sri Lanka is today. राइट श्रीलंका 4,500 पर कैपिटा इनकम पे है. 10 साल बाद हम श्रीलंका बनेंगे. राइट even Sri Lanka is not a competitive market in many ways, right? So 20 years out, when we are pushing close to $9,000, $10,000, we might become a more competitive market, like say a Thailand. Thailand is I think roughly 8,000, $9,000, right? So 10 साल बाद तो श्रीलंका होंगे. 20 साल बाद, by which time I think my career will probably be done. Maybe Vishal, you'll still be doing what you love. But 20 साल बाद, when we are pushing a Thailand type of economy, there could be issues around competitive intensity ratcheting up materially. So the problem with the framework as I've laid it out in Coffee Can Investing or in Unusual Billionaires is that it doesn't take into account that over long periods of time, the market could become far more competitive, right? And hence your initial stock selection could go awry. The reason I didn't lose too much sleep, and the reason I would still say your viewers shouldn't lose too much sleep, is we are such a poor country today that it'll be some time, a decade, more like 2 decades, before competitive intensity materially ratchets up in industries like footwear, like undergarments, like blood tests, so on and so forth.
I completely agree with you on that point that we are still far from becoming a decent developing country, right? Especially given our population as well. and the growth that has stalled for the last 10 years because of all the external reasons out there. Uh, Talking about valuations, right? We've seen valuations, and quality is scarce in India. Quality businesses are scarce in India, and I'm sure you agree with that. Talking about valuation, there's so many businesses, high quality businesses, that have just really run up so intensely, right? And have now actually trading at valuations that are
So,
be.
Vishal, why do you say there are so many high quality businesses? First, the run-up
No,
part I'll
there is
come to.
very few. They're scarce.
हाँ,
They're
so
few.
हमारे देश में if you use the CCP वाला system,
Uh-huh.
15% revenue growth
Uh,
और sorry 15% return on capital and 10% ROC. And I hope you agree it's a relatively robust and simple definition.
I agree with that. Yes,
15% 15% return on capital or more and double digit revenue growth. On that basis, we've got barely 12 franchises in the country. तो बस इतना ही है हिंदुस्तान में 12 कंपनी है सोचने लायक ठीक है नाउ नाउ लेट्स गो टू द रन अप वाला पॉइंट ठीक है नाउ व्हेन वी से रन अप राइट आर वी वरीड की पी 40 है 20 है 70 है राइट आई डोंट थिंक वी वरीड अबाउट पी राइट बिकॉज पी अगर वरीड होना है तो हाउ डू यू नो 70 इज अ प्रॉब्लम why is why should you worry at 70 shouldn't you worry at 140 or is it 30 that worries you right so you have to again put it in a mathematical context right so if you open a basic Excel spreadsheet, बहुत ही simple Excel spreadsheet, right? And do basic Excel. What you'll find is this: if a company grows free cash flow at 25% for the next say 5 years, and after that free cash flow growth decelerates rapidly over the next उसके बाद subsequent 10 years, and by year 15, free cash flow growth is down to 5%. So from today till year 5, 25% free cash flow growth. From year 5 to year 15, deceleration in free cash flow growth. From year 15 onwards, for perpetuity, it's 5% perpetuity. Right? You'll find that the Excel will give you roughly a 25 PE warranted valuation. So let's call this scenario one. Right? 5 साल का गाड़ी चल रहा है उसके बाद ठप हो जाता है 25% आपका 25 पी आता है However, if the same company can sustain 25% free cash flow compounding for 15 years as opposed to 5 years, and after that it decelerates till year 25. So आज से 15 साल 25% free cash flow compounding उसके बाद subsequent decade of deceleration, that company will be roughly worth around 80 PE. This is Excel. This is not I'm not talking about any. This is basic Excel में spreadsheet analysis. And if the same company, Vishal, were able to sustain 25% free cash flow compounding for the next 20 years, you'd see that again on the same Excel DCF, a 250 PE is warranted. So 5 years, 25% free cash flow compounding, warranted valuation 25 PE, 15 years, warranted valuation 80p, 20-25 years warranted valuation 250p. And you can see what I'm getting at, right? The curve is non-linear. ऐसा नहीं जाता. The more the PE perpetuates, the longer the longer the EPS growth perpetuates, the exponentially higher the PE, the warranted PEs. Now we go back again to the Dhanbad versus Mumbai restaurant market. Will free cash flow growth sustain for 20-25 years for a dominant player in Dhanbad? My reckoning is there's a pretty good chance, right? Because whilst there will be increase in competitive intensity in the Dhanbad market, um, unless there is a radical revolution in the country, you'll still have a significant economic opportunity in the Dhanbad of 20 years hence. So just to put it in context, at the turn of the century, Pidilite was already the overwhelming market leader in adhesives. And this is 20 साल पहले. In the last 21 years, Pidilite's free cash flow compounding has been 26%. At the turn of the century, Asian Paints had already been the market leader in paints for 30 years. Right? Since the turn of the century to the current day, Asian Paints' free cash flow compounding has been 24%. At the turn of the century, Titan was already dominant in watches. Tanishq तब तक बना नहीं था. Titan's free cash flow compounding in the last 20 years has been something like 40%, right? So 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 the Dhanbad versus Powai example, the Dhanbad versus Mumbai example, I'm using that to explain why well-run franchises in low competitive intensity markets, and India is a low competitive intensity market. Well-run franchises in a low competitive intensity market can sustain 25% free cash flow compounding, and therefore warrant valuations which are PE multiples of 200 PE and upwards. Now, the challenge with the human mind is twofold. Firstly, a lot of people believe that बहुत सारे अच्छे franchises in India में नहीं है, right? My belief is there's no more than 20 franchises in the country worth investing in the listed market. Unlisted, I don't operate in, right? So mental trap क्या है? पहला mental trap, people think there are 6,000 stocks listed, तो चारों तरफ पैसा फेंको, म्यूचुअल फंड्स में लगाओ, पीएमएस करो, एआईएफ करो, खुद सिंगल स्टॉक पंटिंग करो, राइट? सो मोस्ट पीपल दैट हु watch your show, I suspect they'll have upwards of 50 stocks in their portfolio. And there is no way on God's earth our country has 50 investable businesses in the stock market. So पहला challenge. दूसरा challenge है, people believe that since there are 30, 40, 50 good businesses in the country, their discernment between, say, a Pidilite versus a Jubilant Foodworks, they can't discern. To their mind, both a Pidilite and a Jubilant Foodworks is similar. Neither can they discern between a Nestle and a Unilever, nor can they discern between an Asian Paints and a Kansai Nerolac. Right? In each of these examples, the first company I gave, a Pidilite, an Asian Paints, a Nestle, is those 20-year compounding stories. The second example are decent companies, but they don't have the free cash flow compounding legs. But it's very hard for the average person to discern. So what does the mind do? Remember, Daniel Kahneman has taught us. In fact, वो जो किताब आपके शोल्डर के पीछे दिख रही है उसमें भी explain किया same चीज. When our mind cannot deal with a difficult question, it substitutes a difficult question with an easier one. So when our mind says, यार मेरे को क्या पता Jubilant Foodworks अच्छी है या Pidilite अच्छी है, who the hell knows? The mind can't grapple with that. So what does the mind do? P किसकी कम है भैया? And let's invest with that, right? हाँ, so जो सस्ता पी होगा वो ले लो because वो ज़्यादा चलेगा, right? And you can't blame people, but at the same time, my job, your job, our job is to say those are the behavioral traps that people will fall into. That leaves for people like Marcellus an arbitrage. Because the average Joe will not answer the difficult question. The difficult question is kya? Why is Pidilite a better franchise than, say, a Jubilant Foodworks? Why is Nestle a better franchise than, say, Unilever? That's a difficult question because it's a lot of work. Perhaps as long as 2 years of work to answer that simple question, right? Since the typical investor will not have the resources or the time to answer this question, they will answer the easier question, which is P kiski kam hai. That opens up arbitrage for you and me, which is why living in India is so much fun.
And probably also because that P is the most readily available number when you're looking
हाँ,
at stocks, right?
so the difficult
Easy,
question
easy.
नहीं answer
Right,
करना,
right,
easy
right.
question answer करना है.
That's right, that's
So
right.
so Danny Kahneman put it in his books. 400 साल 500 साल पहले अकबर बीरबल की कहानी है, फेमस अकबर बीरबल कहानी, सेम थिंग, राइट? A man loses his ring at night, वो उसका अंगूठा खो जाता है. So बीरबल is walking home and he sees the man searching under a street light. तो यार क्या हुआ भैया? He says नहीं, अंगूठी खो गई. So बीरबल said, did you lose it here? He said नहीं, I lost it over there in the darkness, but रोशनी यहाँ पे है इसलिए यहाँ पे ढूंढ रहा हूँ. So same insight from Akbar Birbal and from Danny Kahneman, and very relevant in the stock market, gives you and me lovely arbitrage opportunities.
Man, sure. That's exactly what I was trying to get to right before, like we talked about this aspect. So I mentioned that the number of franchises, as you mentioned, are very scarce in India, and there's a huge growth opportunity, as you rightly mentioned, right, for cities like Dhanbad, for a country like India, over the next 20-25 years. And so I was seeking your rationale that is the reason that people should ignore a PE of 80-20 that had been usual benchmarks in the past, right? A high PE means an expensive stock and you should avoid it. And I got your rationale through your response. Now, my question connecting to that is, what could go wrong in this kind of an approach, right? What is your biggest so even when you invest using this approach, right, which makes a lot of sense, even for investors who are investing for the next 20, 30 years, right? uh, which is the biggest fear factor that really keeps you awake at night while following this approach of investing?
हाँ जी. So history can give you and me a very good sense of what happens in such situations, right? So there are several instances in other countries. Let me take just one in the interest of time. So America in 1880 onwards, just like India has got networked in the last 10 years, America का networking process 1880 के आसपास शुरू हुआ. 1880 the railroads got built out properly. 1890s में telegraph का roll out हुआ. 1910 में Model T Ford आया. And before 1920 the road network got built out. So you networked America जस्ट लाइक योर नेटवर्किंग इंडिया. लास्ट 10 ईयर्स में इंडिया में रोड नेटवर्क डबल हुआ है. लोकल डोमेस्टिक फ्लाइट्स में पैसेंजर ट्रैफिक क्वाड्रुपल हुआ है. ब्रॉडबैंड कनेक्शन कुछ 70 गुना बढ़ा है. जीएसटी आ गई है. सो योर नेटवर्किंग इंडिया 1880 to 1930 यू नेटवर्क अमेरिका. नाउ as you network a country, what are you effectively doing? You are telling the local chota business that you got to go head to head with the national giant. राइट. पहले नेशनल जायंट अपने इलाके में था, बॉम्बे में था या दिल्ली में था. नाउ यू मिस्टर फुटवेयर मैन्युफैक्चरर इन अहमदाबाद, यू हैव टू गो हेड टू हेड विथ रिलैक्सो. You, Mr. Pathlab owner in Bhilai, you have to go head to head with Dr. Lal Pathlabs. You, local adhesive manufacturer in Kanpur, you have to go head to head with Pidilite, right? So obviously that's a hopeless battle. The Chotu regional Chotu gets eaten up, crushed, acquired, etc., and you consolidate the economy. So 1880 to 1930, this is exactly what happened. It's called the Gilded Age in America. People like Vanderbilt, Rockefeller, JP Morgan, Carnegie, they were the people who consolidated America. Japan went through a similar process in the 50 years after the Second World War. Now, India is going through an identical process. So when I moved to India, Vishal, in 2008, the top 20 businesses accounted for 30% of India's profits. Now the top 20 businesses account for 90% of India's profits, right? Epic profit concentration. Now, इसमें क्या होता है? You can see क्या होता है, right? Public चूचा करने लगती है, right? Public चूचा करने लगती है, and the politician starts thinking कुछ करना चाहिए. Now, अमेरिका में same thing happened. 1892, the Sherman Act was expedited. Antitrust litigation, antitrust policy लाया गया. But as you'd expect, smart people like the Carnegies, the Rockefellers made sure that policy तो आ गया, but कोई काम नहीं हुआ उस पे, right? And it was basically another 15-20 years before the American government moved to start breaking up these massive business empires. So Standard Oil को तोड़ा गया, US Steel को तोड़ा गया, right? Now उस जमाने में, this is the pre TV, pre newspaper, pre social media era. It took time for the electorate to get the politician to do something about it, right? And therefore, by the time the public did something about it, America's Gilded Age, 40 years of epic consolidation, economic consolidation हो गया. Companies like Kellogg's, like Heinz, like Pillsbury, Wrigley's, they all became national giants, and that's the America we know today. So there was a public outrage कि इतने कम promoters के पास इतना सारा power कैसे आ रहा है, इतना profits कैसे आ रहा है, कुछ कीजिए इसके बारे में. But before the polity could do anything, the polity moved so slowly that the consolidation was done. Now we're going through a similar process in our country, and I have no idea how at what stage the jumping up and down starts on this subject. Obviously the companies themselves are very smart. They know exactly how to deal with this. They have their strategies and policies in place, but it's a subject on which you and I have very, very little control. So the economic consolidation will be relentless. आपके मेरे सामने होगा, and the whole country will roll up into the hands of basically 15 families. It'll be relentless. What you and I don't have visibility on is the democratic and political forces behind the scenes, and when and how they will play out.
Talking about Marcellus, right? You and your team manage more than 10,000 crore for thousands of clients, if that those numbers are right. This means that just a 5% change in your portfolio caused by a rise or fall in the market may lead you to gain or lose like 500 crore in quick time. Now, notwithstanding that, and just given the idea of managing so much money and under so much expectations, given the wonderful performance that you've shown over the past 3 years, how do you manage to stay calm and stick to your investment philosophy and not get carried away with index moves or sectors where you don't invest? So that's question number one. The second question is, with each of your move being publicized, how do you deal with overwhelming amount of praise or criticism all over media and social media? So the idea is to get your view on how do you manage to stay calm, stay detached from what you're doing.
Well, I don't know whether we are calm or detached. I think that only people who sort of see us every day will be able to say. But what I can tell you is what we have, the processes and the system we have built, the team we have built. So so the so the decisions are not really made by some all-seeing, all-knowing fund manager or managers. It's a it's a well specified intellectual construct, right? The intellectual construct, the research construct, and it's laid out in diamonds in the dust. By the way, most of it, right? 70% ADI, 100% ADI. Otherwise, we won't have a job. So bulk of our intellectual framework is given in diamonds in the dust. So that intellectual framework operates in such a way that there's very little room for subjectivity. So, for example, if there is a specific way that succession planning is assessed and points are given, so each franchise is given points for succession planning. Within succession planning, there are specific attributes that a franchise has to demonstrate to get those points. So, for example, we need to see a certain type of board composition. We need to see a certain type of training and grooming process for CXOs, right? So by making it extremely objective, we have taken the emotion out of it as much as we can. So market chade ya gire, the rigor in the research process is maintained, and the analysts are in charge of that. The fund managers supervise the research, but the analyst's job is to put the data on the table. एक बार एनालिस्ट ने टेबल पे डेटा डाल दिया, there is very little scope for us to say, no, although you have shown me that the board is weak and it's a lala company run by promoter and his bachchas, I'm still going to give it a great score on succession planning, because the analyst will say क्या कर रहे हो, the framework doesn't allow you to do that. You can't defy the framework. So by creating a granular framework which is sort of structured in a way where it's a bunch of specific items which drive the score for the company, we have tried to take emotion out of it. Just because Saurabh likes a company or the promoter is a friend of Saurabh doesn't mean it will make it into the portfolio. That research framework is also the position sizing framework. And the position sizing framework allows us to pretty much ignore the markets. I'll give you an example of this. So last year, January, February, March, Bajaj Finance fell, I think, 70% in COVID, the COVID panic of Jan, Feb, March. The Bajaj Finance fell 70%. So on 1st January 2020, Bajaj Finance was 9% of our CCV portfolio, and by 1st April, it was, because of the correction, it was down to 3%, right? And everybody in the country was shouting up and down, jumping up and down, saying Bajaj Finance का ये हो गया, वो हो गया, right? Famous fund managers saying मैं तो निकल गया बॉस Bajaj Finance से. So we were a little perplexed as to क्यों उछल कूद कर रहे हैं, because as per our framework and as per the data that our research team was collecting, the Bajaj Finance as a franchise was stronger on 15th April 2020 than it was on 1st January 2020. The competition was in disarray. Bajaj Finance's cost of money had fallen in the preceding 90 days. Um, in the consumer durable market, we were getting news that this was the only financier operating. So we honestly couldn't understand. So in late April, we tripled our position in Bajaj Finance. Right. So because of the framework and the data associated which drives the framework, it's not really an emotional call for us up or down. जब का बेचना होता है या खरीदना होता है, right? There have been exits we've made, large exits we've made, and we've done it without any great emotional wear and tear. Um, where I think it'll get harder, Vishal, if I had to look ahead, where it'll get harder is when we start seeing developments which are outside our framework. Right, the framework has been built by a whole bunch of us, and we worked together for a decade or so. So, in fact, for several of us, more than a decade, because we've sort of worked together and we think we know India pretty well. हमने एक अच्छी सी framework बनाई है. But there will be a time where something will happen which is not featured in the framework. And I think that's when the real test will come. जब तक events happen within the framework will help us position size up or down, regardless of how the stock prices are doing.
When it comes to a specific idea, right, what is your decision making framework for knowing when to compromise on an idea? So I take you just to give an example of Ben Graham and Geico, right? So Ben Graham had a very like a very solid framework that he talked about, but he also mentioned when it came to Geico, right? He broke a lot of the rules, right? He over concentrated on Geico. He picked up a stock which was expensive by standards, right? And it worked very well for him. He mentions that it was a matter of luck, but it that luck was backed by a lot of preparation, right? So my question is, even when you are working on a process, on a framework, when do you know that you have to change something in the process, given that it may have stopped working for you? Has there been such an experience for you in the past? Uh, if you can share an
Yeah,
example over
sure.
there.
So I'll still tell you what the hard part is. Um, so let's take an example. So so say succession planning, right? So it's clearly an important element of investing in India, right? We are now 30 years into the post 91 reforms. A lot of promoters in our country are pushing. A lot of promoters in our country are now pushing north of 70. And if they haven't thought through succession planning, you and I are going to be exposed as investors, right? So it's important for you and me to understand the succession planning score, and there's this very rigorous way that the research team has created for assessing for creating the succession planning score. Now the question is, in the total score that we give a franchise, what should be the weight of the succession planning score? Score to calculate kar liya, right? But should succession planning have an equal weight as moat, or is it actually even more important than moat? Because after all, if tomorrow the promoter is not in the picture anymore and the franchise falls apart, तो moat लेके करोगे क्या आप? Right? Those are the debates which are hard to answer. So everybody in the team weighs in, and that's where there's a little bit of over time the thinking changes. Weight क्या डालना चाहिए? So the framework itself improves incrementally month upon year. So for example, we can come up with a new way of finessing the succession planning score. But the bigger challenges are around the weight to attach to, say, and I'm using succession planning as an example. How much weight do you attach to succession planning? Should it be as much as moat, more than moat, less than moat, right? Is the weight for succession planning the same in a large cap portfolio and in a small cap portfolio, or is in a small cap portfolio does succession planning have lower weight, right? Because to expect a small company where the Lalaji is abdicating control is a little unrealistic, right? But whereas in a large cap company, 30-40 billion dollar market cap, they've got IIT, IIM guys coming in, and the promoter can hand over a lot of control. So that's where the hard aspect of the job is, and this is where there are no books available. You have to use your common sense, your experience of the country, your colleagues' experience of the country. You have to make sure that the entire team contributes their experience on a debate like this, because these are critical debates. What is the weight of succession planning in our position sizing framework? It's a massive debate. We don't have a fixed answer to it. This is where over time, we can shift our thinking.
My next question is on investment mistakes, right? So when you look back your own investment mistakes over the past 15, 17 years of becoming an investor, right? Were there any common elements or themes that you can remember? And if you were to pick out, right, which has been your most memorable mistake, one that led you to a valuable lesson that helped you become better later?
So in a way, diamonds in the dust arose from our fixing our own mistakes to some extent.
Hmm.
So remember when you first came to talk to us? I think it was 3 years or so ago, Vishal,
3 years, yeah, that's right.
right? So at that stage, right, we were very moat obsessed, because जैसा होता है, you read American books, and there's a mixture of CFAs and MBAs in our office. तो काफी एक मोट का एक obsession रहता था तब. And like most other nerdy analysts, we were very moat obsessed. Um, I think it honestly took us ITC to figure out that capital allocation is just as big a deal as moat. and that's why in Diamonds in the Dust, there's equal amount of space dedicated to capital allocation and how one can assess it as there is to moat, right, and comparative advantage. And the reason ITC was, I think, was such a vivid example to us of the shortcomings of our own clarity on investing was ITC, as everybody knows, right? Its dominance of cigarettes is unquestionable. I mean, unless if somebody is questioning ITC's dominance in cigarettes, I think they need to go and do some serious introspection, because ITC's dominance in cigarettes is unquestionable. Because they are so dominant in cigarettes, and cigarettes is such a lucrative franchise, there's a lot of cash that they throw off, and a lot of that cash is sitting on the balance sheet, and they haven't been able to figure out how to meaningfully deploy the best part of, I would say, 40,000 crores, right, 35,000 crores perhaps now. That obviously acts as a drag on ROC, but more than acting as a drag on ROC, the difficulty of deploying that 35,000 crores in a high ROC investment, and I have sympathy for them. If you ask me, I don't know how to deploy. Forget 35,000 crores. I probably won't even know how to deploy 5,000 crores in a high ROC opportunity in the country, right? But be that as it may, the ITC management are running the show. Their difficulty, their challenge, their inability to deploy very high free cash flows at incrementally higher ROCs meant that we couldn't see how ITC could sustain, say, 20% EPS compounding over the next decade, right? So if you analyze ITC as a moat company, it's like perfect, tick tick tick, puri jaga, right? Governance is all right, accounts are all right, moat is good, but hey, capital allocation. So that's when we realized that we needed to do a lot more work on capital allocation, and hence the a lot of the material and Diamonds in the Dust in the capital allocation chapter got written as we were increasing our muscle on the capital allocation side.
Uh, you've written five wonderful books, right? So, Coffee Can Investing, Unusual Billionaires, Gurus of Chaos, The Victory Project, and the latest one being Diamonds in the Dust. If I were to ask, which of these did you enjoy writing the most and why? I'm sure you enjoyed everyone, but if you were to pick your favorites out of these five, which one would it be and why?
I think the first and the last have been most satisfying. In a way, Gurus of Chaos was very satisfying because, in a way, it was my learning process. Right? It was the people I had learned from, say, B.N. Manjunath Saab, Shankaran Naren, Sanjay Bhattacharya. Um, I've learned a lot from these people, and by writing up my learnings, by writing up those interviews, it clarified my thinking, and it was also a way to basically give my tribute to people who had taken their valuable time and spent hours teaching me about how to think about investing. Right, when I came to India, I didn't really know so much about, I didn't know anything about the country, and I didn't know much about investing. I was more a analyst slash broker. So Gurus of Chaos was very satisfying because pehli bar you're putting your thoughts on paper, you're putting your Gurus' thoughts on paper, and it was, I think, even now I really enjoy reading Gurus of Chaos. Uh, um, um, Diamonds in the Dust was very satisfying because for the first time, we as a team, as a group of people who have worked together for 10, 15 years, um, have created a research framework, an investment framework, which is being used to run, lots of money, 10,000 odd crores, which is practical, which is simple, which is in a way the distillation of our entire lifetime's learning. So Diamonds in the Dust, in a ways, are are putting on the table that this is what, say, 45 years of living on this planet has taught us. So in their own ways, these two books have been very satisfying. In a way, having written Diamond in the Dust, honestly, unless our thinking on investing clarifies and improves radically in the years ahead, we might not be able to write any more books on investing. So for us to write another book on investing, we'll have to work very hard on improving our skill set further. We will work very hard, but मैं आपको गारंटी नहीं दे सकता कि हम सक्सेसफुल रहेंगे in that endeavor, because honestly, Diamond in the Dust is every page we have packed with our life's learnings, either on frameworks और ऑन केस स्टडीज, राइट? करीबन फ्रॉड के 4 केस स्टडी हैं, कैपिटल एलोकेशन के 5 केस स्टडी है, कॉम्पेरेटिव एडवांटेज के 5 केस स्टडी है. सो 13 केस स्टडीज वी हैव गिवन यू वॉट एवर वी हैव लर्नड एंड वी पुट एवरी फ्रेमवर्क वी हैव लर्नड अबाउट इन्वेस्टिंग इन अ सिंपल कॉन्स्ट्रक्ट.
Talking about COVID, the world and like India, we've all been through a significant shift in the past 2 years, almost like less than 2 years, in terms of how we look at life, investing, and everything. Right? Uh, uh, what has changed for you from the post-COVID world to the world that we are living now? Right? Both in terms of life and investing. So, what are the biggest lessons that you've learned out of this crisis?
So first off, I think it's worth waiting for a little while, Vishal, before we take a view on COVID, because I don't think there's been enough distance between COVID and us for us to give a realistic view on the subject. I think let's wait for another year. If there is a third wave, obviously, we'll still be living through COVID, so no point giving a view about COVID when we're living through COVID. And if a year passes without the third wave, if a year passes without Vishal without a third wave, my reckoning is a lot of stuff will return to what it was in 2019. So it's one of those things that as an investor, you learn to not dwell upon too much. If the third wave is going to come, we'll still be grappling with COVID, and if it's not going to come, I'll be astonished if on 31st August 2022, life is radically different in India to compared to what it was in 2019, 2020. I'm sorry.
In a world where software, as Mark Andreessen says, right, it is literally eating the world, how does one as a decision maker safeguard human judgment that risks getting replaced by AI or machines?
So I think the answer, rather than asking me, I think the answer lies in Danny Kahneman's noise, right? So as he lays out in the book, there'll be many different areas where the human mind makes noisy decisions, and software will take over. So I think a classic example is I think appraisal processes of companies, right? At the moment, we all kind of do a touchy feely appraisal, and basis the boss's decision somewhat arbitrarily, we give people performance ratings which translate into bonuses and pay rises. Similarly, recruitment decisions are equally arbitrary. So I think, using the noise wala framework from Danny Kahneman, it's highly likely that in future software will be intimately involved in saying what is Vishal's inputs on Saurabh's performance in the last 12 months. So there'll be prompts that Vishal will have to plug in about Saurabh's performance, and the software will spit out a performance score or a rating, performance rating for Saurabh, rather than Vishal himself spitting it out, right? And similarly for interviewing, rather than Vishal saying, Saurabh saying, basis, I like this candidate basis some random attributes, right? Perhaps he went to the same college as me, or perhaps he also writes books. तो अच्छा ही होगा बंदा, अच्छी किताबें लिखता होगा तो. Rather than that, I think we're highly likely to go to a world where we will fire in inputs from our interview into a software, and the software will make the decision, right? So that's the first sort of learning, that I as a manager or a recruiter, I won't become redundant, but between me and the decision, there'll be a machine, right? And at the machine could be a basic spreadsheet, or it could have AI and ML and all that stuff inside it. I think the second aspect is where the task is a repetitive task, same cheese bar bar, right? So the an analogy that Kahneman cites and lots of other books cite this is the people who look at X-ray images, right? The radiography professionals. It's the same job again and again. And in the book, there's a lovely example of how a very basic AI algo can outperform human beings, right? So where it's a repetitive task, and the same task is being repeated again and again with very specific, with very tightly defined specifications, the machine will almost certainly take over. Right now, the question is, between these two scenarios I painted, investing falls into which category? Is investing like interviewing a person, with some specific attributes you're looking for, and you fire that into software. The software gives you a buy sell decision. Or is investing like looking at X-rays and figuring out whether there's a fracture or a breast cancer and so on, right? My reckoning is investing is more like the former, where rather than randomly sort of deciding that I like this stock, promoter अच्छी बातें करता है यार, promoter अच्छी बातें करता है, annual report भी बढ़िया लगा मेरे को, or I spoke to a couple of friends of mine, they said tremendous franchise, right? Rather than doing that, we move to a world where there's a very precisely defined contours which my colleagues and I have to go and collect the data on. We fire the data into a model, quantitative or qualitative, and the outcome's the answer. I think that's where investing will end up going, rather than the option where the whole thing will get automated. In the Western world, it might get automated, but in a country like ours, जहाँ पे आप टी शर्ट बेच सकते हो at 60% ROC with minimal competition, it'll be a while coming, the automation piece.
If you were teaching a class of, say, three hardworking and curious students who wanted to be investors, and you knew that at the end of a year long course, you had to hire all three of them to be on your team, how would you structure the course? So, basically, what are the most important things you will teach them to do and things they should avoid doing in this 1 year?
So look, the three things that I've believed from a very young age have worked for worked for me and worked for most people that I've seen around me. And the three things that I've tried to look for in the people that we recruit is firstly, intelligence. That's reasonably easy to actually spot in interviews and through someone's track record. But then there are two aspects which are much harder to spot in someone's track record, and especially in an interview setting. So, firstly, the intelligence easy part है वो spot करना. Second part is industry मेहनत, right? Because sitting in front of you, someone who says I've got all these degrees and I've worked in all these prestigious places, um, how do you know the person actually works hard? It could well be that they've had a very privileged upbringing. They've been to good schools and universities because they've come from a fortunate startup society. Um, um, uh, uh, how do you know that their outcomes in life are due to hard work rather than due to the rather than being born in the right family, a privileged family. So you typically have to do a little bit of background work on the analyst, on the candidate, whether it's in sales or research and ops, to figure out, is this person a hardworking person who's worked his backside flat or her backside flat for the last 10 years, right? So easiest to spot in an interview is intelligence. Re- with a little bit of work, you can figure out the hard work aspect, the industry aspect. Hardest to spot, almost impossible to spot in an interview, is the third aspect, integrity, right? वो बहुत difficult है spot करना. You can do background checks and ref checks, but as you know, Vishal, right? When you call up people who don't want to say anything on the person, they said नहीं नहीं मैं तो खास जानता नहीं था उसको, right? So very rarely in India will someone say boss मत करो, this is a tricky person. So those are the three things. And if you had to structure a course which could help people learn intelligence, industry, and ethics, integrity, then I would love to be on the course first off myself.
So, sort of, we are nearing the end of this conversation. So, I have a few quick questions for you. The first question is: you recently mentioned in an article that often the books that are most useful for investors are those that have nothing to do with investing. So, which are your favorite non-investing books that you highly advise people to read?
Right. So this bit, right, I learned from Sir John Kay as well. So when he did the book launch for Diamonds in the Dust, he said recently, and he told me this a long time back. So I've just continued learning from the great man. So he said in the Diamonds in the Dust book launch that how do you learn independent thought? Somebody asked him, and he said, read read material that you disagree with. Right? Read things that you disagree with, because that's how you build independence and thought. So taking a cue from John, uh, 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 what I figured out reading his books and reading the stuff that his book references suggest is often you learn the most about investing when you read books outside investing. So the analogy with Rahul Dravid I gave you earlier in the interview, which is in Diamonds in the Dust, That really hit home when I read Timeless Steel, which is a book of essays on Dravid, edited by Sambit Bal. I think the outstanding collection of essays. That's brilliant, right? It's like mesmeric how good that collection of essays is. So that's where the whole mental fortitude, patience, mental training aspect hit home. Then about conviction and about maintaining conviction, being contrarian, going against the received wisdom, against terrific odds. That concept got embedded by reading biographies on Muhammad Ali. The most memorable biography on Muhammad Ali is David Remnick. He was the editor of the New Yorker. David Remnick's biography called King of the World. King of the World, Muhammad Ali, The Rise of an American Hero. Right, brilliant biography, Pulitzer Prize winning biography. If you don't like reading, you can also watch the movie One Night in Miami. It came out last year. I think it's on OTT. Watch One Night in Miami to understand what Muhammad Ali was and why his life is a lesson for us in how to build and maintain conviction under the greatest duress. Then there's a whole concept of what is information, what is knowledge, right? What is information, what is knowledge, how does information and knowledge result in wealth, right? These are actually quite difficult concepts. The man who has explained this most clearly is a man called Joel Mukherjea. He's a professor in America. He's written a book called The Gifts of Athena. The Gifts of Athena. It's a book on the knowledge economy. It goes back 250 years ago. It's got beautifully detailed case studies of how knowledge and information are fundamentally different, how science and technology are fundamentally different, how science comes first, technology comes second, and the application of technology leads to wealth and progress. Right? And this is relevant for us because knowledge, information, science, technology is now the core to building wealth in our era. The era of hathodo pitoing and doing Purana style capex is not going to make wealth for you and me. So to understand how exactly information knowledge translates into wealth, Joel Mokir's book is fabulous.
Wonderful. In the last few years, what new habit has most improved your life? Overall, what habit would you say most positively impacts your life?
I think trying to read one book a week hota nahi hai, but I find that if that whole attempt, if I read one book every other week as well, I think I find it immensely useful. It's not just enjoyable, it's relaxing, it's recharging, and the mental frameworks keep improving. You have to push yourself a little bit to do it. You have to push yourself a little bit to do it. But I found it always helps to have next to you a big pile of books like you have behind you. So next to my bed, next to my table, in the living room, in our TV room, everywhere, there's books. And I think just push yourself to read more and more. Switch off from social media, switch off from the world around you, and get locked into a world where your mind just develops week after week, year after year. The 1% compounding story that you began the interview with.
Thank you. And here's my closing question. So, if there is a final piece of lesson you would want to leave the listeners with, what would it be?
And I don't think I'm so wise, Vishal, to have any final lessons for anybody. I'll just say that there's a lot of people who will give you a lot of negative commentary about India and about prospects of the world after COVID. Uh, I would say don't listen to the naysayers. Yes, in every country, at every point in time, there are problems, but I think we are extremely, extremely fortunate to be living in India in this 30, 40 year period where the country is getting integrated. The next decade, there'll be enormous wealth creation for people who are mentally prepared to grab those opportunities. Just make sure you're one of those who's mentally prepared to grab the opportunities that the Indian economy presents as it consolidates into the hands of well-run businesses.
Wonderful. So, thank you, Saurabh, for the amazing conversation that we've had of the
Yes,
past one and a
thank you for
half
having me.
hours. Right. Really enjoyed a lot of insights for me, and thanks for writing all the wonderful books and the work that you're doing at Marcellus. Thank you so
Thanks a
much.
lot, Vishal.
Take care.